Be prepared for it to happen this year. Have enough gold and silver wherever you need it to survive the immediate aftermath of a dollar collapse. It could happen any time. It could definitely happen this year. I focus on the monetary philosophical aspect of these markets. I mean, I understand investment demand, I understand industrial demand, but monetary demand is a completely different thing, because investment demand is what silver stackers do. It's like we stack silver. Why? Because we know that something big is going to happen. And whether we realize it or not, what that big thing is that an explosion of actual monetary demand. And what is monetary demand versus investment demand? Investment demand is when you stack silver in anticipation of monetary demand, because you expect the monetary system to break down. And monetary demand is different from industrial demand because everyone demands money. Everyone needs money for something. Otherwise, there is no division of labor. So that's a much more fundamental thing. When we look at the futures markets of silver priced, whether it's on the LBMA or the COMEX or whatever the contract is, what's the price of what we're looking at? We're looking at the price of industrial demand and some investment demand, but we're not looking at the price of monetary demand, because monetary demand is when everybody wants it to exchange against other goods.
In this discussion, led by Rafi Farber, we delve into the intricate dynamics of monetary systems, focusing particularly on the role of gold and silver in times of economic turbulence. Farber, a prominent figure in the financial industry renowned for his insightful analysis, shares his perspective on the unfolding monetary crisis and the pivotal significance of precious metals. Throughout the discourse, Farber provides astute observations on historical precedents, current market trends, and potential future scenarios, offering valuable insights into the broader economic landscape. Join us as we explore the implications of inflationary pressures, the actions of central banks, and the evolving role of alternative currencies in a world on the brink of profound change.
And when that happens, that's when gold to silver falls to like 15 to 1, as it does in every monetary panic in history. That's what always happens. Why? Because most people can't afford gold, so they go to silver, which is already starting to happen, but it has a lot more to fall. It fell to 15 to 1 in 1918. It fell to 15 to 1 in 1980. It's going to fall to 15 to 1 again, and that's when we are in a full-blown monetary crisis. What I keep saying, everyone sees prices going up everywhere in the world. It's not a goods problem, it's a money problem. It's a money problem because we see basic necessities going up faster than any other prices. So everyone's focused on, the broad inflation numbers. They don't matter. They do not matter, because in any hyperinflationary economy, you have basic necessities going up really, really fast, and luxury items either not going up at all or going up much slower than basic necessities.
There's a theory floating around that when the next monetary panic hits, we'll see gold to silver ratios plummeting down to around 15 to 1. This isn't anything new, apparently. History supposedly repeats itself in this regard. The idea is that when folks can't afford gold anymore, they turn to silver, and that's when the ratio drops dramatically. It happened in 1918 and again in 1980, and it's predicted to happen again when we're in a proper monetary crisis. Farber seems to suggest that while everyone's talking about inflation, the real issue lies in the money itself. Basic necessities are apparently skyrocketing in price, while luxury items are either stagnant or increasing at a much slower rate. This, according to Farber, is the hallmark of an impending financial crisis. In this scenario, it's speculated that once central banks start reversing their policies due to mounting pressure, precious metals will become the target. Farber predicts a scenario where silver will be drained from all the major stockpiles, like COMEX or LBMA, as people scramble to protect their wealth. He even points out a curious incident from July 2020, where the number of delivery requests supposedly exceeded the amount of registered silver available. Allegedly, J.P. Morgan had to shift a significant amount of silver from one category to another to meet the demand. Farber also brings up some rule changes in COMEX back in 1980, implying that these changes were made because they could be, and not necessarily because they were warranted by the situation. He mentions that around that time, the valuation of gold was apparently enough to back all of the Fed's liabilities on its balance sheet, essentially putting the country on a de facto gold and silver standard. But, as with any hearsay, it's important to take these claims with a grain of salt, and do your own research to verify the accuracy of the information.
1980 brought us back on a gold and silver standard, so since we were already there, the COMEX had the ability to mess around with the rules. But if they do that in this environment where the Fed has absolutely no ability to raise interest rates anywhere near 20%, forget it, it's impossible. If they change the rules in this environment, then all the demand would just flood into the physical markets and everyone would just ignore the COMEX, and who cares what they say? It doesn't matter. They won't have the power, because instead of dollars trading for paper silver on a futures exchange, you'd just have that futures exchange ignored completely, and physical silver would be exchanged for goods on some kind of decentralized panic, the segmented market, where people would be trading physical coins or some kind of reliable backing of a certificate for them for actual goods and services, which would be the end game that we're all looking at, where gold and silver become money again, literally. We've never seen in the history of the world a currency backed by a basket of commodities. That's it's a nice, people try to spin these intellectual theories on money that we've never seen before, and I don't think are possible. Look, gold and silver are money. Baskets of commodities are not money. Every time that some country comes up with some kind of scheme to use, whether it's real estate or tobacco or whatever, as money, it doesn't last long. Gold and silver are money, and that's it. And as for the formation of BRICS into some kind of a new currency, it would have to be gold and silver backed in order to supplant the dollar, which is what they're going to have to do. But if they do that, they're going to have to become fiscally responsible.
The situation in 1980 supposedly pushed us back onto a gold and silver standard. Because we were already teetering on the edge of such a system, COMEX apparently felt empowered to play around with the rules. However, if they were to try that now, when the Federal Reserve is practically handcuffed, unable to hike interest rates anywhere near the 20% mark, it would be futile. Changing the rules in such a scenario would only drive demand straight into the physical markets, rendering COMEX irrelevant. In a panic scenario, people would likely resort to trading physical silver for goods and services, bypassing any centralized exchange altogether. Farber seems to believe that gold and silver are the only true forms of money, dismissing the notion of currency backed by a basket of commodities as unrealistic intellectual musings. As for the idea of BRICS forming a new currency, Farber casts doubt on their ability to do so without backing it with gold and silver. He questions the fiscal responsibility of these nations, suggesting that any move towards a new currency would likely be a reactive response to market forces rather than a proactive measure. Farber's perspective seems to hinge on the belief that the public will ultimately dictate the course of the market, especially in times of crisis. He advises readiness for a potential collapse of the dollar, emphasizing the importance of holding enough gold and silver to weather the storm. While he suggests that the collapse could happen at any time, he also acknowledges the uncertainty surrounding timing, citing the historical resilience of inflationary systems. In essence, Farber paints a grim picture of the current economic trajectory, predicting that the exponential rise in inflation will inevitably lead to a catastrophic endpoint unless the course is somehow altered. He doubts the Fed's ability to veer off this path without resorting to the familiar tactic of reversing their policies, which has historically only postponed the inevitable.